For most of the modern era, global power has been relatively easy to identify. The United States sat at the center of the world's economic, military, and financial system. Its influence shaped trade, security, technology, culture, and the rules that governed international life. Even countries that disagreed with the US often depended on it. That arrangement didn't happen by accident. After World War II, the United States emerged with unmatched industrial capacity, financial strength, and military reach. It built and anchored the institutions that still organize global life today. The dollar became the world's primary currency. American markets became the deepest and most liquid. American technology and culture spread everywhere. For decades, that system worked because there was no true alternative. But over the last 20 years, something changed. Quietly at first, then more visibly, China began to rise, not just as a manufacturing hub, but as a strategic power with global ambitions of its own. Forward to 2025, it is shaping how supply chains are built, how technology is developed, how alliances are formed, and how risk is priced. And while headlines often frame the US China relationship as a dramatic showdown, the reality is more subtle and more consequential. What we're witnessing is not a sudden handover of power, it's a prolonged transition in how global influence is earned, exercised, and constrained. To understand where this rivalry is headed, it helps to look at how each country arrived here. China's rise is one of the most significant economic transformations in history. In the late 20th century, China was still largely agrarian, poor, and inward looking. Over time, it leveraged cheap labor, state coordination, and export driven growth to integrate itself into the global economy. Manufacturing moved to China because it was efficient, scalable, and reliable. As exports surged, so did investment, infrastructure, and technological capability. By the 2010s, China was no longer just the world's factory. It was modernizing its military, building digital infrastructure, investing abroad, and developing its own technological ecosystems. Its strategy was disciplined and patient: attract capital, scale production, close the technology gap, and expand influence. For a long time, that strategy worked with little resistance. The US benefited from cheap goods, corporations benefited from lower costs, global growth accelerated. The assumption was that economic integration would eventually lead to convergence. That assumption is no longer the guiding policy. The rivalry today is not just about trade or tariffs, it spans technology, supply chains, military positioning, currency systems, and ideology. Each of these areas reinforces the others. Of all, technology sits at the center, because advanced computing, artificial intelligence, semiconductors, biotechnology, and space capabilities are no longer just commercial assets. They are strategic foundations. Whoever controls the most advanced technology shapes productivity, security, and long term growth. The United States still leads in research, advanced chip design, software, and innovation ecosystems, though. Its universities, venture capital networks, and talent attraction remain unmatched. China, meanwhile, excels at scale, speed of deployment, and manufacturing integration. It can take existing technologies and roll them out rapidly across massive markets. But the most critical contest is over semiconductors, because modern economies run on chips. Control over advanced chip design and fabrication determines who can build the next generation of technology. This is why restrictions, subsidies, and industrial policy have intensified. Supply chains are the second front. The pandemic revealed how dependent the world had become on China for essential goods: electronics, pharmaceuticals, rare earths, industrial components, all concentrated in one geography. That concentration was efficient but fragile. Since then, the US and its allies have moved to reduce risk. Manufacturing is being diversified. Production is shifting to Southeast Asia, Mexico, and back to North America in strategic areas. This doesn't eliminate China's manufacturing power, but it does weaken its dominance. The shift is slow, expensive, and uneven, but as we end 2025, it is clearly underway. Military power adds another layer to the fry. The US retains an unmatched global reach, logistics, and alliance networks, at least used to, but now things are changing with the current government's America's First policy. And China, on the other hand, has focused on regional strength, particularly in the Pacific. Its navy has grown rapidly, and its missile and cyber capabilities are increasingly sophisticated. Direct conflict between the two countries, however, remains unlikely, but the strategic tension is real. Both sides are positioning for deterrence rather than confrontation, but that balance is delicate and it shapes everything from defense spending to diplomacy. Currency power is quieter but equally important. The US dollar remains the backbone of global finance. Most trade, debt, and reserves are still dollar denominated, but China has been pushing for alternatives in past years. Yuan based trade, digital currency experiments, and partnerships within groups like BRICS. The discussion of de dollarization has been discussed frequently, but in practice it is limited. Trust, liquidity, and legal stability still favor the dollar. What's changing is not dominance, but diversification. Some countries are seeking options, even if they don't fully replace the dollar. And underlying all of this is ideology. The US projects influence through open markets, private capital, culture, and alliances, while China promotes a state centered model that emphasizes control, infrastructure, and long term planning. Many countries don't fully align with either, but they navigate between them for now. This creates a world that is less unified and more fragmented. What makes 2025 different is that both countries are facing constraints at the same time. China is confronting challenges it hasn't faced before. Its population is shrinking. Youth unemployment is high. The property sector, once a growth engine, is under severe strain. Local governments are burdened with debt. Growth has slowed, and the old model is losing momentum. These pressures don't signal collapse, but they do limit flexibility. China is now managing its first major internal adjustment while trying to maintain external influence. At the same time, the US is rebuilding parts of its economic base. Manufacturing investment is returning in targeted areas. The US remains the primary destination for global capital and talent. Its demographics, while not perfect, are healthier than many peers. Despite political dysfunction, the underlying economic engine remains resilient. So, who is winning? The answer depends on what winning means. In terms of overall economic strength, the US holds an advantage. Growth is slower than in the past, but more flexible. Consumers still drive global demand, and innovation remains concentrated. Militarily, the US retains superiority through alliances and global reach, even as China narrows the gap regionally. Technologically, the US still leads at the frontier, though China is catching up quickly in application and scale. In manufacturing, China remains dominant, but diversification is eroding its monopoly. In currency power, the dollar remains central. But as the US struggles with its own internal conflicts and continues its isolation policy, 2026 is the year to watch for. The deeper truth is that the real battlefield is not territory or ideology alone, it's innovation. The next 50 years will be shaped by who leads in artificial intelligence, computing, biotechnology, energy systems, and space. The US excels at creating breakthroughs. China excels at scaling them. That dynamic is why the rivalry is so intense and so enduring. For the rest of the world, This rivalry raises costs and complexity. For individuals, the implications are tangible. Prices reflect fragmented systems. Job markets shift as manufacturing relocates, and skills tied to technology, data, engineering, and analysis become more valuable. This is not a decade defined by fear, it's a decade defined by strategy. The global power shift is real, but it is not sudden. It rewards those who understand it early and respond deliberately. The rivalry between the US and China is not about who dominates tomorrow, it's about who shapes the rules of the long run. And in 2026, that long run may be quietly renegotiated.